Peirce from the Securities Exchange Commission, where we're going to really find out what's going on. This is really tremendous. So thank you very much for being here. This is a continuation of a great conference, and we appreciate your coming all the way from DC. Thank you.
Thank you, John. I remember one of the last times I saw John, I told him that I was at a used book sale and I found his book, one of his books in the sociology section. And I said, hey, John, what was your book doing in the sociology section? He said, what were you doing in the sociology section? It's a real pleasure to be here at Hoover. I'm really honored and frankly a bit surprised to be here. After all, for me, monetary policy sits in this box in my brain that says, save for later, a lot later. In college, when economics rocked my world, which it did, it was micro, not macro, that rocked my world. I was fascinated to see the push and pull of incentives on individuals' decisions about how they would spend their time and their money. To remind me of those life-changing lessons, I still sport a t-shirt that I got back then. It said, I saw the invisible hand at Case Western Reserve University. But in contrast to micro, macro was, for me, too abstract, focused on the aggregate. It didn't help me understand the world in which I lived. It wasn't until later that I realized that those macroeconomic models that seemed so rickety to me and the assumptions underlying them were forming the gospel basis for a lot of policy in Washington, D.C. My periodic attempts to peer into the world of monetary policy are almost always unsettling, unless they're guided by a lot of people here in the room who view monetary policy with humility and with also a recognition of the grave consequences of getting it wrong. But I wasn't invited here to speak about monetary policy, and I'm here to speak about staying in one's lane, and so that's what I'm going to do, apart from remarking that sound monetary policy is deeply important to the markets I regulate. So in the vein of staying in my lane, I will remind you that my views are my own views as a commissioner at the SEC and not necessarily those of the SEC or my fellow commissioners. Government agencies often wander outside of their lanes. My own agency, for example, has been on a mission over recent years to classify just about anything as a security. That was very evident to me last year when we charged the creators of Stoner Cats, a web series, with violations. We charged them with selling digital cats as part of an effort to create a buzz for a series. We said that was a securities offering. My colleague, Commissioner Ueda, and I, at the time, wrote that if we had taken that same approach back in the 70s, Star Wars collectibles would also have been securities. Also last year, the Commission charged a company $35 million for, among other things, failing to collect and review employee complaints about workplace misconduct. As one observer noted, quote, historically, companies have expected scrutiny from the EEOC and other civil rights regulators and have understood the risk of private litigation related to workplace misconduct, but have not expected the SEC to involve itself. The SEC is also involving itself in cybersecurity and climate. Recent rules, although styled as disclosure rules for public companies on these topics, will change how companies approach these risks. But the Commission is not the only jurisdictional glutton in DC, and we're often on the receiving end of other agencies' territory grabs. Any defense of SEC jurisdiction coming from an SEC commissioner is probably going to be suspect, but I do ask that you would bear with me because I think the vibrancy, flexibility, and resilience of the American economy are at issue here. And I think you'll hear in my comments today some themes that we heard earlier today from Ross and Christina, among others, about regulation. The U.S. is remarkable for many reasons, including its large, efficient, and liquid capital markets. In contrast to many countries in which banks are the most important funding source, the securities markets are critically important to the American economy. Unlike banks, which by their nature tend to be risk-averse and conservative, the capital markets are a good match for innovative, flexible, dynamic, and a competitive economy. Well-functioning capital markets reflect the broader society. Ludwig von Mises explained it this way: a stock market is crucial to the existence of capitalism and private property, for it means that there is a functioning market in the exchange of private titles to the means of production. There can be no genuine private ownership of capital without a stock market. There can be no true socialism if such a market is allowed to exist. Capital markets give individual investors a place to express with their cold, hard cash what they view about a company's success, about technologies, and about products, what they think is going to happen, what will succeed. Based on their own knowledge and experience and expectations, they take risks in other people's ideas. For an investor, nothing ventured, nothing gained encapsulates the understanding that we place our money at risk when we hand it over to an asset manager or tell a broker-dealer to buy shares in a public company for us. We hold very different expectations when we deposit our biweekly paycheck at the bank. Bank financing is important to the economy, but it allocates capital differently than the securities markets do. Among other differences is the greater effect of government regulations on bank lending decisions. The government's interest in managing bank risk-taking derives in part from its provision of deposit insurance, of course, and the government's propensity to bail out even uninsured depositors. Since the government's ultimately on the hook if banks mess up, the government wants a say in how they manage themselves. Banks are accustomed to the assertive presence of regulators, even having regulators take up residence right in the banks. Regulation, sometimes in the pursuit of non-financial objectives, circumscribes activities by banks, and it encourages other activities. Economist Henry Simons understood the importance of minimizing, I'm quoting here, minimizing political influence in the allocation of investment funds, which is why he argued for limiting the role of banks in mobilizing funds for investment. In taking on credit risk, banks respond to market signals, but regulatory signals are very strong, whether stated explicitly or hinted at, and so they certainly listen to those as they shape their decisions. Equity and debt financing, by contrast, responds much more directly to the market because its availability and cost is reliant on the decisions of a wide range of people whose money is on the line. And core to the success of the securities markets is that failure is a possibility. There's no government insurance program, there are no constantly hovering supervisors, but it's unforgiving market discipline that hems in participants in the capital markets. Investors face the consequences of their own decision-making, wise or foolish. If the government will not make good on your losses, you have to think hard about whether you want to take the risk in the first place. Investors can lose their entire investment when a company fails, which makes them probably do a little due diligence, or at least learn a hard lesson if they don't. Likewise, fund investors have a strong incentive to do some vetting and monitoring before they hand their money over to an asset manager. The differences between capital markets and bank financing are reflected in how they're regulated. The former is subject primarily to disclosure and the attendant anti-fraud regulation, and the latter to prudential regulation. Bank regulation is prescriptive to achieve stability and continuity, but capital markets regulation relies heavily on disruptive, competitive, and innovation to keep the markets healthy. The SEC is at its best as a disclosure regulator. We seek to ensure that investors obtain the material information they need to make decisions. We don't try to make the decisions for them about how to invest. We get out of the way and let that competitive game play out. 1/3 of our mission is to protect investors, but we accomplish that objective by just making sure that they're getting truthful and accurate material information so that if they choose, they can be informed about their investments before they make them. but we don't limit their investment opportunities. Bank regulators, by contrast, sometimes view less transparency as helpful. I think we heard something about that this morning. One could argue that a full transparency approach would be more effective for bank regulation too, but I'm trying to stay in my lane here. As yet another symptom of an increasingly risk-averse society, the mindset and sensibilities of banking regulators are seeping into the SEC. We see that attitudinal shift in what we're doing. We seem to have forgotten that capital markets are not actually about safety and soundness and survival of individual firms, but they're about resilience and growth through rough and tumble competition. Congress didn't make the SEC a systemic risk regulator, but we're running around now all the time saying that's exactly what we are. And we use it to justify all kinds of things, regulating private funds, regulating service providers, reining in artificial intelligence, anything else we can think of. Systemic risk is handy because, again, I think as was referred to earlier by Christina, having this sort of systemic risk, financial stability, gives you a lot of discretion because it's kind of hazy as to what it is. We do have the ability to regulate the activities of mutual funds, broker-dealers, and market intermediaries, but we're wielding that authority in new and interventionist ways. Prescriptions about handling of equity market orders, increasingly granular cybersecurity mandates, strategy-altering liquidity rules for mutual funds. These are some examples of our greater willingness to replace private decision-making with our own. And increasingly, we're reaching into the operations of entities we don't even regulate. We do that sort of indirectly, but we're trying to get into their operations as well. Each of these measures is going to stand and fall on its own merits, but the general trend is toward greater control of all the participants we regulate, and even some that we don't. One notable example of this trend toward more substantive prudential type prescriptive regulation is what we are doing with private fund advisors. Traditionally, advisors to private funds, which don't have retail, they're not retail oriented, we left them a lot of regulatory leeway to do what they wanted. Closer oversight began with Dodd-Frank when the SEC directed us to start registering private fund advisors, and once you start registering entities, there will be more regulation that follows. And sure enough, that is true. Dodd-Frank also created the Financial Stability Oversight Council, and they gave us a role to collect information for the FSOC about private funds, which we do through a form called Form PF. Recent expansions of that form and the data that we collect there will be great fodder for future prudential regulatory interventions. I think a really significant change, though, came last year when we adopted a set of rules for private fund advisors, which we cast as disclosure rules, but they're sort of substantive rules hiding under that disclosure wrapper. And I think they will form the basis for additional regulation in the future. Before this rulemaking, fund investors and advisors shaped their relationships through contract. You decided if you wanted to give up a term in order to get something else that mattered to you. It was competition, not regulatory prescriptions, that defined that relationship. Now the Commission has assumed the Tribune's mantle to protect downtrodden fund investors, such as pension plans and endowments, represented by very well-compensated investment professionals. So investors looking to gain leverage in those contract negotiations had come to us and said, hey, you know, we can't get the information we need. When I said to them, well, why don't you just walk away? They would say, well, we're scared of missing out, which doesn't really give me a lot of confidence. But anyway, so they did ask for more information to increase their leverage, but there was also pressure that was coming from outside the SEC, and specifically from prudential regulators who want more focus on private funds, including by us. They view private funds as a threat to financial stability. Some funds are highly leveraged, some rely on short-term funding and sell during times of stress. which may transmit material stress to banks. And as large players in the financial markets, hedge funds activities certainly do affect the financial system and other participants in it. Bank regulators, of course, know that there are interconnections, and they have their regulatory authority. They can work with banks to manage their exposures to hedge funds. But on balance, I would argue that hedge funds and other private funds contribute to the resilience of the financial system by being nimble sources of liquidity, even during times of stress, albeit perhaps at prices that sellers don't want to sell at, especially when Uncle Sam is ready to come in and offer a better price. The diversity of hedge fund managers, though, I think ensures that when some are selling, there will be others to stand by and buy, as long as the government doesn't upset that dynamic. So the best way to ensure that hedge funds contribute to the resilience of the financial markets is to keep the barriers to entry and exit low, and to avoid regulation that homogenizes hedge fund strategies. And then even during times of market stress, the focus has to be not on the well-being of any individual institution, but on the well-being of the markets as a whole. As the experience with private funds illustrates, prudential regulators have nudged the Commission toward more prescriptive and prudential regulation. Much of this pressure comes from the FSOC. Most notably, the FSOC has been instrumental in changes to money market fund regulation. In 2012, 2 years after the SEC adopted post-crisis money market fund liquidity reforms, FSOC proposed to use its authority under Dodd-Frank to get us to do more. And among other things, they wanted us to make structural reforms to reduce the risk of runs and significant problems spreading through the financial system. We responded in 2014 with some of the approaches that FSOC asked, including a floating net asset value for institutional prime funds. The Commission also adopted threshold-triggered discretionary redemption gates and fees, which ended up then causing a problem in March 2020. The Federal Reserve responded to these problems with Treasury sign-off, with liquidity facilities, and so as you can imagine, that led to further calls for money market fund reforms, which the Commission responded to in 2023. Sensibly, we got rid of the fees and the gates threshold, but we added a new mandatory liquidity fee for prime funds, and that seems to be doing its perhaps intended job of killing off the remaining prime institutional money market funds. These funds' absence will be felt by the issuers of short-term commercial paper, but the private issuer's loss is Treasury's gain if they're looking for someone to buy their Treasuries. A better result would have been to quash any expectations of government support and encourage not one-size-fits-all solutions, but tailored solutions designed by sponsors of money market funds that would work during times of financial stress. That heterogeneity, again, I think can be a source of strength in the system and actually better at fostering stability than a uniform regulatory prescription. But prudential regulators are not content to urge us to act like prudential regulators. They're eyeing more direct control over our markets and participants. So as I told you at the beginning, the SEC is seeing lots of things these days as securities. Commission, the Federal Reserve and prudential regulators see a bank in every financial institution, or at least something lurking in the shadows that ought to be regulated by one. So money market funds, open-end funds, mutual funds, private funds, their advisors, large asset managers, all of these fall within the broad category of non-bank financial institutions that prudential regulators are now eyeing. FSOC's introduction into the regulatory pantheon laid the groundwork for a new regulatory approach. Congress created FSOC, among other reasons, to identify risks to the financial stability of the U.S. that could arise from the material financial distress or failure or ongoing activities of non-bank financial companies. FSOC has a couple options. It can make recommendations to the primary regulator, and that's what it proposed to do with money market funds, or it can require supervision by the Board of Governors of the Federal Reserve for non-bank financial companies that may pose risks to the financial stability of the U.S. FSOC has kind of gone back and forth with this designation authority, trying to figure out how to put that into action. It has made some designations in the past, ran into a court that didn't quite agree with how they'd done it. So last year, most recently, FSOC rejected the approach that had been taken following that court loss, and they rejected it with palpable vehemence, and instead flipped back to an approach where the designation authority is no longer going to be a last resort. It's going to be the hammer at the top of their toolbox. Cost-benefit analysis, unnecessary. Assessment of the company's likelihood of material financial distress, unnecessary. So we're moving away from an activities-based approach now to really where we're likely, I think, to see some designations. Again, I have no insight into this. I'm not breaking news here. But based on the rules that FSOC just adopted and the guidance they just adopted, they're saying, look, we think that we can look at asset managers and funds and think about designating them. The fact that commenters highlighted that a prudential regulatory framework focused on safety and soundness for banking institutions is fundamentally incompatible with the capital markets, where investors knowingly put their capital at risk, did not move the FSOC. And so this is where we are. We may be facing Federal Reserve regulation, and with that, attendant measures such as risk-based capital requirements, liquidity minimums, and leverage limits. The pivot back toward designating entities as systemic is reflective of a misplaced focus, I would argue, by prudential regulators on funds. I mean, again, money market funds was one thing, but now we're at the next step. Now we're looking at all open-end funds. This is at the heart of our capital markets. Prudential regulators point with alarm to the size of the open-end fund industry. They point to characteristics such as daily redemption, a lack of government insurance scheme, funds interconnection, and funds performance during times of stress. They're pushing measures such as liquidity requirements, which we actually did propose, stepped up liquidity requirements for open-end funds. We proposed those in 2022. That included a swing pricing requirement, which has gotten a lot of negative attention. Prudential regulation for open-end funds is not only unnecessary, but I argue that it will contribute to undermining the resilience of the financial system. Funds that offer daily redemption in a portfolio composed of assets of different liquidity levels have long existed. Their track record is good, even in times of stress. FSB and FSOC blame these funds for aggravating market stress during periods like March 2020, but laying the blame for the COVID-related stress and the government response to that stress at the feet of open-end funds strikes me as a stretch, given the widespread economic uncertainty at that time. There was heavy selling, but there was heavy selling across all of the markets. The transparency of fund holdings, the heterogeneity of funds, the widespread ownership of funds by investors with a wide range of preferences, and fund sponsors' deep experience in managing redemptions mitigate systemic risk concerns. Prudential regulation would undermine these strengths, and by extension, I argue, would undermine the efficacy and the resilience of the financial system. Regulating funds in a bank-like way will sap these entities of the characteristics that enable them to nimbly and flexibly serve the economy. Bank-like regulations that focus on mitigating risk, even if imposed by historically non-prudential SEC regulators would be a poor match for an industry that is designed to finance entrepreneurial risk-taking. Designating funds as asset managers as systemically important and adding them to the growing ambit of Federal Reserve regulated entities would lessen their own incentives to manage risk. A designation likely carries with it a market expectation of too big to fail, and the possibility of a bailout would dull the now keen risk sensitivity of asset managers. And then we have to grapple with the fact that to protect its own reputation, if it is regulating these entities, the Federal Reserve is going to face temptations to engage in bailouts. And then, of course, the prudential regulation that would follow a designation will have some of the same consequences that these kinds of regulations have on banks. We'll see constraints and pressures, and some of those constraints and pressures will not be related to risk, but will be more political in nature. Finally, the hoped-for benefits of a prudential fund regulator are not achievable because, I hate to admit it, but regulators, including prudential regulators, are people too. So I'm reminded of Hayek's takedown of the economic man who is, quote, supposed to know automatically all that is relevant for his decisions. So too must we reject a model that assumes a regulator who automatically knows all that's relevant for her decisions. To again riff off Hayek, that quasi-omniscient government regulator is the skeleton in our cupboard that keeps popping out to promise that next time will be different if we just give her a little more control. Regulators have neither the knowledge nor the will to make better decisions than the participants in our capital markets. To the fastidious and well-ordered mind of a bank regulator, the capital markets are messy things, but that messiness is beautiful to me. I dread the day when I have to trade in my old college t-shirt with a new one that says, "The invisible hand is dead, long live the Fed." Centralizing decision-making at the Federal Reserve is not the way to bring stability. To quote Simons again, centralization of power is a product of disorder. In advanced societies, it is retrogression induced by disasters. Prudential regulatory encroachment on the capital markets erodes the decentralized decision-making that is so critical to our healthy economy. Capital markets aren't perfect. We see bubbles, bad behavior, begging for bailouts, big bailouts as a result of that begging, and bankruptcies. Some of these problems are the result of poor decision-making by market participants, regulators, or monetary policymakers. We will never eliminate those bad decisions, but keeping people in their lanes will enable them to make better decisions. The SEC should focus on getting investors the information they need. Bank regulators should focus on regulating banks. Central bankers should focus on monetary policy. All of these are big and important jobs on their own. We don't need them moonlighting in other people's lanes. Finally, to focus investors' minds on their task at hand and keep them out of the bailout begging business, we need to remind them, with our actions as much as with our words, that in capital markets, failure is a possibility, but government bailouts are not. You've been a very gracious audience. You've had to listen to me over lunch. I'm not an economist, and if I had been an economist, my field wouldn't have been monetary policy. So I really appreciate that, and I think it just goes to show there's no such thing as a free lunch. I'm happy to answer any questions if you have any.